You're not supposed to say this out loud, but here it is. Japan is collapsing, and the ripple effects are already reaching your wallet. What's happening isn't some local slowdown. This is the world's third largest economy falling to its knees, and if you think it won't affect you, think again. From your mortgage rate to your retirement account, from food prices to your next investment, everything is shifting. For decades, Japan was the poster child for stability, innovation, discipline, growth. But right now, it's drowning in debt, inflation, and demographic decline, and dragging global markets down with it. Wall Street is already shaking. Bitcoin's going haywire. Bonds are crumbling. And while governments downplay the panic, insiders are quietly moving their money and reworking their investment strategies. What does this mean for you? Simple. If you don't understand how this collapse spreads, you'll be blindsided. But if you stick around, I'll break it all down. Why Japan's fall is just the beginning, and how you can position yourself not just to survive this chaos, but to make money while the old system burns. You know something's wrong when even the world's most disciplined economy starts stumbling. Japan's Q1 numbers just came out, and they're ugly. The economy is shrinking, big time. And while the headlines try to play it down, the reality for everyday people is brutal. Grocery bills are climbing, salaries aren't, and Tokyo's efforts to tame inflation feel like trying to hold back a flood with duct tape. If you want a real warning sign, look at Japan's auto giants, Toyota, Nissan, Honda. These powerhouses are forecasting serious trouble ahead. Global demand is softening, production is slowing, and supply chains are still limping. When exports fall, manufacturing takes a hit. That means layoffs, tighter wallets, and a ripple effect across global markets. And if you think this won't touch your stock portfolio, think again. Meanwhile, the average Japanese household is stuck. Prices are rising, but wages are flat, or worse, declining. The government keeps injecting stimulus, but it's like giving a sugar rush to a patient in intensive care. It's not fixing the underlying illness. That's why more and more people are turning to online business models and digital side hustles. The old system, it's breaking. People are desperately chasing financial freedom, not luxury, just basic security. And here's the kicker. This isn't just about Japan. A shrinking economy in the world's third largest financial power sends a loud message. The system we rely on isn't bulletproof. Retirees are returning to work, young adults are delaying marriage and family, and the debt is piling up faster than ever. Japan's massive debt bubble is no longer just a future threat, it's pressing in right now. But the scariest part? Japan's problems don't stay in Japan. When a country this interconnected starts spiraling, the impact hits global interest rates, asset markets, and every serious investor's investment strategy. And if you think that's bad, wait until you see what happens when Japan's influence starts shaking up US debt and worldwide rates. Japan isn't just another economy, it's one of the world's biggest creditors. With over $1 trillion in US debt, when Japan sneezes, global interest rates catch a cold. That massive holding of US treasuries gives Japan unique leverage. But now, as their economy contracts, they're starting to pull back. And that creates shockwaves in places far beyond Tokyo. You might not live in Japan, but your mortgage, your 401k, and even your ability to make money online can feel the pressure. When Japan begins selling off US debt or simply stops buying, it weakens demand for treasuries. Less demand means lower prices, and lower prices mean higher yields. Translation: borrowing gets more expensive. For everyone, countries, corporations, you. Suddenly, those cheap loans that fueled a decade of online business growth start drying up. It's a domino effect, and Japan is the first tile. And we're not just talking about government bonds. Stock portfolios worldwide are sensitive to every move Japan makes. When they shift their investments inward, pulling cash from global markets, volatility surges. The S&P 500 jitters, Nasdaq plunges, Bitcoin rallies one day and crashes the next. This isn't coincidence, it's correlation. Japan's economic pulse plays background music for global finance. For everyday people trying to build financial freedom, this adds another layer of challenge. Interest rates inch up, and that dream house suddenly costs $200 more per month. Credit card debt climbs faster. Small business owners pay more to borrow. Investors feel the pressure, forcing them to rethink their entire investment strategy. Dollar cost averaging sounds safer than ever. So the next time you hear Japan in the financial news, don't zone out, lean in, because the carry-on effects are already bleeding into your world. And one of the most explosive examples of this is something called the yen carry trade, which is now coming undone in real time. Here's where it gets wild. For years, investors around the globe used a powerful tactic called the yen carry trade. It's simple in theory: borrow Japanese yen at super low interest rates, convert it into dollars or euros, and invest in higher yielding assets abroad. Free profit, right? As long as the yen stayed weak and rates stayed low, it worked like magic, until now. With Japan's monetary policy tightening and the yen unexpectedly gaining strength, that house of cards is collapsing. Traders are rushing to unwind their positions, selling US stocks, crypto, foreign bonds to repay their yen debts. And that sudden selling is causing a chain reaction. Bitcoin plummets, tech stocks nosedive, global investors are left holding the bag. It's not just hedge funds feeling the heat. Ordinary investors who followed the momentum, who piled into US growth stocks, ETFs, or altcoins during the boom, are now watching their portfolios bleed. Many don't even realize the yen carry trade was a silent puppet master behind the scenes. It wasn't just speculation. It was structural leverage on a global scale. Now, the volatility is baked in. The unwinding of these trades creates a whiplash effect across markets. And it's not a once-and-done correction. It happens in waves. That means we'll keep seeing weird price swings, failed rallies, and false bottoms. For anyone serious about making money or protecting assets, this is the time to study the macro game, not just the meme stocks. And while the carry trade collapsing is shaking up risk markets, there's an even deeper problem forming beneath the surface, one that hits the very foundation of Japan's own financial system. Let's talk about what happens when a country's own government bond market starts falling apart. Japan's government bond market has long been considered one of the most stable in the world. That's changing fast. As inflation creeps up and the central bank begins adjusting its policies, bond yields are rising. But here's the twist: nobody wants to buy them. Recent auctions failed miserably. Investors are losing confidence. And confidence is everything when you're sitting on the world's highest debt to GDP ratio. As yields rise, the value of existing bonds drops. That's devastating for banks, pension funds, and insurance companies holding massive amounts of Japanese debt. These institutions rely on bond stability to stay afloat. When bond values plummet, their balance sheets start cracking, and when the foundation crumbles, the whole building's at risk. Retail investors, too, are waking up. Traditional savings tools, like Japanese government bonds, no longer feel safe. That pushes people toward riskier assets, from foreign equities to Bitcoin, even if they don't fully understand them. It's financial survival mode. People aren't looking to get rich. They're trying not to go broke. And here's the kicker. A failed bond market makes raising capital more expensive. For a country as indebted as Japan, that's a death spiral. More borrowing leads to higher rates, which leads to more failed auctions, which leads to, well, you get the picture. And remember, if Japan can't borrow affordably, neither can the rest of the world. Global rates rise in sympathy. But this financial pressure isn't just about numbers. It's also about people. And when you look at Japan's population, another ticking time bomb emerges, one that no monetary policy can fix. Japan has a people problem. Nearly 30% of its population is over 65. The birth rate is so low, some towns report more funerals than births. This isn't just a social challenge, it's an economic nightmare. Fewer workers mean less productivity, less tax revenue, and fewer people to support a growing wave of retirees who rely on public pensions. The result? A system under unbearable strain. Healthcare costs are ballooning. Pension obligations are exploding. And young workers, already dealing with wage stagnation and shrinking job opportunities, are now burdened with supporting a retirement system that may not be there for them. It's no wonder so many are turning to online businesses or global income strategies just to stay afloat. Meanwhile, The shrinking workforce means companies are struggling to find labor. That slows down innovation and makes it harder to compete globally. Automation is rising, but that's not a cure-all. It doesn't replace the consumer base that's aging out of spending. Japan's legendary export engine is running low on fuel. And with a debt-to-GDP ratio over 260%, the government doesn't have much room to maneuver. It's stuck between cutting programs for the elderly, which would be politically suicidal, or borrowing more to keep the system alive. But remember, bond markets are already cracking. It's like trying to put out a fire with gasoline. With Japan's aging population draining public resources and shrinking its economic engine, the country's ability to invest abroad is fading. And that leads us to the next major threat. Japan is no longer the reliable global investor it once was. Infrastructure, emerging market projects, you name it. Their capital kept international borrowing costs low and global liquidity high. But that era is ending. As Japan raises its own interest rates to fight inflation, investing abroad makes less sense. Why take foreign risk when you can earn more at home? The result is a slow, quiet retreat. Japanese banks and pension funds are pulling back from international markets. That leaves a funding gap, especially in places like the US bond market, where Japan was once a key buyer. Less demand means higher yields. That means higher borrowing costs. That means pressure on everything from real estate to credit cards to startup capital. And this isn't just theoretical. We're already seeing the shift. Treasury auctions are getting softer. Foreign participation is thinning. Yields are climbing, and suddenly safe assets don't feel so safe. That's how a financial crisis begins, not with a crash, but with a whimper that becomes a scream. For those chasing financial freedom, this is a wake-up call. It's not enough to follow yesterday's playbook. You need a flexible investment strategy, one that accounts for shifting global dynamics. That could mean more exposure to commodities, defensive stocks, or even decentralization plays like Bitcoin or gold. And speaking of decentralized plays, some Japanese companies are already pivoting toward crypto as a hedge. One of the most talked about cases, a firm called Metaplanet, which is placing a massive bet on the future of decentralized finance. Metaplanet might not be a household name yet, but their strategy is making serious waves. In the face of Japan's bond market chaos, they're doing something radical, shifting huge amounts of their capital into Bitcoin. To them, this isn't speculation, it's survival. When confidence in central banks erodes, people start looking for assets that can't be printed, frozen, or manipulated, and they're not alone. Investors across Japan, from retail to institutional, are starting to reimagine their portfolios. Bonds are losing their shine. Traditional assets look unstable. Enter Bitcoin. It offers liquidity, transparency, and most importantly, independence. In a system drowning in debt and inflation, decentralization is becoming a lifeline. Of course, Bitcoin comes with risk, volatility, regulation, unknowns. But when your country's bond yields are unpredictable and your currency is falling, even volatile assets start to look appealing. This isn't about greed anymore. It's about protecting capital from a system that's clearly breaking down. And for many, it's the only play that still makes sense. This shift also reflects a deeper transformation. Japan is starting to question the entire architecture of traditional finance. It's not just about making money, it's about preserving value. A new generation of Japanese investors are exploring digital wallets, decentralized exchanges, and building online businesses powered by blockchain. They want freedom, financial freedom, from a system they no longer trust. But as more institutions embrace crypto, Japan's government faces a brutal decision. Can they keep printing money and suppressing interest rates? Or will they finally have to let go of the fantasy and face the consequences? Either way, what comes next could define the next decade, not just for Japan, but for the entire global economy. Japan is backed into a corner, staring at two options, both terrible. First, it could raise interest rates to try and stabilize the yen and tame inflation. But doing that would blow up its already unsustainable national debt. Higher rates mean higher interest payments. With debt to GDP over 260%, even a small rate hike could send the budget spiraling into collapse. The second option? Keep rates low, pretend everything's fine, and watch the yen continue to sink. That might buy short-term relief, but it comes at the cost of economic collapse. Inflation eats away savings. Imports become more expensive. Consumer trust erodes. It's a slow bleed that eventually becomes a free fall. There's no easy way out. This is what economists call a lose-lose scenario. Every move triggers pain. Every delay amplifies risk. It's no longer about stimulus or austerity. It's about survival. Japan is facing the same kind of economic trap that brought down empires. It's not hyperbole. It's math. And the world is watching. The implications are global. A Japanese crash sends tremors through the stock market, US treasuries, global banks, and emerging markets. Investors worldwide must rethink their investment strategy. Diversify, hedge, adapt. Sitting still is the worst thing you can do right now. And the bigger question looms, how did we get here in the first place? Why are countries stuck choosing between inflation and insolvency? That answer lies in a story much bigger than Japan. It's the end of an era, the era of easy money. For decades, cheap debt ran the world. Interest rates near zero, central banks printing trillions, endless bailouts, it all seemed normal. But that party's over. Inflation, debt fatigue, and geopolitical shocks have shattered the illusion. The free money era is done, and people who built their lives and businesses around it are waking up to a harsh new reality. What we're seeing now is the great reset of finance. The rise of Bitcoin isn't just a tech fad, it's a response. A response to systems that manipulate currencies, bury countries in debt, and promise prosperity while quietly draining wealth. Bitcoin doesn't care about GDP or politics. It's math. It's code. And for many, it's hope. This shift isn't just about crypto, it's about decentralization. People are building online businesses, side hustles, independent income streams, anything to escape the trap. Financial freedom used to be a dream. Now it's a necessity. No one wants to rely on broken pensions, volatile markets, or currency devaluation. People want control. The markets are starting to reflect this. Investors are reevaluating everything: bonds, stocks, even real estate. Long-term plays are back in focus. Dollar cost averaging is regaining popularity. Defensive assets like gold, silver, and Bitcoin are rising. It's not about chasing highs anymore, it's about building resilience. The world is changing. Japan's collapse isn't just a local crisis. It's a flashing red signal that the old financial model no longer works. And if you're not paying attention, you'll be blindsided by what's coming next. But if you are, then you're already ahead of the curve.